Great, thanks. Well, I'm here today to hopefully answer the question, does ESG have a place in bond portfolios, and more specifically in ETFs? Before I go into how ESG does have a place in bond portfolios, I thought I'd take a step back and have a look at how fixed income is used in ETFs. On this slide, we can see a graph of the rapid growth in fixed income ETFs over the last few years. If you look at the light blue line, you can see that assets under management have been growing by around 20% year on year and have just reached $300 billion in total assets under management. And over the last 2 years, fixed income ETFs have taken around half the total flows going into the EMEA ETF market. So why is this? Well, we think there are several reasons for fixed income ETFs to be growing so rapidly. There are some key advantages for using ETFs over either both direct investment and versus mutual funds. If we take a look at these versus direct bond holdings, the first obvious reason is diversification. If you're an individual investor trying to access bonds, fixed income, individual fixed income investment, you're going to struggle with the minimum trading sizes for bonds and the way they trade over the counter. If we take an example of that, the Euro Corporate Bond Index has around 3,000 constituents from 700 issuers, with minimum trading sizes, minimum increments of between 2,000 and 100,000, which means that it's very hard for all but the largest of investors to get a truly diverse portfolio. Secondly is rebalancing. With a fixed income ETF, the rebalancing is done automatically. Depending on the share class that you choose, the income is either reinvested or paid out on a regular schedule, and you don't have to monitor new issues. The next point, and I think this is key, is access to trading relationships of a large asset manager. The true cost of investing in fixed income isn't solely about the fee that may be charged for the fund or the ETF, but it's actually about the trading costs. When you're accessing an ETF, fixed income via an ETF, you're accessing the trading relationships of very large asset managers who get the most favourable pricing from their counterparties. Another potential is the revenue from securities lending. Again, due to the scale of the ETF, we can benefit investors through lending securities and returning some of that income to the fund. And finally is efficiency. Being able to trade one line of stock to invest a cash flow or to rebalance a portfolio, change an asset allocation, is a very efficient way of investing in fixed income rather than having to trade a whole range of bonds. Relative to mutual funds, there are again a number of advantages. Firstly, transparency. The nature of ETFs is that they have to be very transparent to be able to price intraday. So a whole list of the holdings is available on a daily basis. Liquidity is another factor. Unlike mutual funds, ETFs trade in the secondary market, so any creations or liquidations, redemptions, can be traded within the secondary market without the need to buy or sell individual underlying bonds. Then there's the precise nature. Active funds tend to have broad benchmarks to gain asset class exposure. With ETFs, you actually have the ability to target very niche parts of a market, such as AT1s or hybrid bonds, which are available via active managers, but you're relying on their timing and selection of those instruments. And the last points are just the ease of access. Again, I mentioned that the ability to trade one line and the low cost. ETFs tend to be much lower costs than mutual funds. And just moving on to the growth that we've seen in ESG. If we look at the left-hand chart here, the line shows the growth of total assets in ESG ETFs, and the bars show the total number of ESG ETFs available. And you can see that from around the end of 2018, there has been a very sharp increase in the amount of assets under management in ESG ETFs. But just looking at the overall picture is hiding part of the story. If you look at the right-hand chart, I've broken down the ESG growth between equity and fixed income. If you look at the green line, you can see that accounts for most of that rapid growth, and that is the total assets under management for equity ESG ETFs. And you can see the purple bars next to that are also showing the number of equity ESG ETFs available. And you can see that growth has kind of followed the number of products that are available. If you look at the pink line and the orange bars, That shows you the fixed income ETF asset growth. And what you can see there is a marked difference. The number of products has grown much more slowly, and the total assets under management has also grown far slower than it has for equities. This is a little bit like the origins of the whole ETF marketplace. Equities were the early adopters of the ETF market, rapidly growing and accepting passive management within the equity space. Similarly, more recently, ESG has been seen as an equity phenomenon because of the voting rights that come with equity ownership. However, working within fixed income, the whole idea of being a good owner of your assets and to work within the ESG space, I think is going to see a huge increase in fixed income ESG ETFs in coming months and years. If we look at that, the number of products has doubled in the last 18 months. It's gone from around 20 to around 40 fixed income ESG ETFs. And if you look at the development, we're probably around 2 to 3 years behind the development in the equity ETF space. So we're just at that cusp when ESG investing really took off for equities, and I think we're just on the cusp of that upward trend in fixed income now. And then how do you incorporate ESG into fixed income? ESG is often talked about as just a single idea, a single asset class. But actually there are many different flavours, many different shades of green within that. On this slide I've included a few of the key fixed income ESG indices. If you look at the table on the left-hand side, at the bottom, you have ESG screen. This is the lightest touch ESG available. This just simply applies screens to the worst offenders in the ESG space, those that would get a controversy score of 0 under the MSCI indices. Next up from that is SRI, socially responsible investing. This applies slightly more stringent criteria than the ESG screened indices, but still is basically an exclusions-based methodology. At the top of that, you then have sustainable. Now, sustainable goes a step further. Sustainable indices both have the negative screens that I've mentioned with the ESG screened and SRI indices, but it also applies positive screens to only include the best in class. Now, the problem with all these, you've heard me use the word exclusion a number of times. To increase the ESG score, we're tightening up the universe that is available for investment. So to increase the ESG score, what you're effectively doing is increasing the tracking error versus the base index that you may be looking for within that asset class. We've tried to demonstrate that with the chart on the right. This shows you the tracking error versus the base index versus the improvements in ESG score. And you can see that basically the ESG screen gives you a small improvement in score, but a small increase in tracking versus the base index. SRA takes you up a little step further, and then we move on to that sustainable space where it's really quite a restricted universe and will give you quite a high tracking error versus a base index. So actually it might not look totally like the asset class that you're looking to invest in. And this slide just really shows this in a slightly different way. Basically, you're starting on the left with your asset class, whether that's governments, corporates, or an aggregate bond type index. And then you're applying the ESG rating to this. Now, I should sort of mention that MSCI have a seven-point scale for their ESG rating from AAA down to CCC. So AAA and AA are classed as the leaders, and the CCCs and single Bs would be looked at as the laggards. And what you can see is basically from that ESG screened approach to the lighter screen within that middle block, you just have a few exclusions of the worst offenders. As I mentioned, SRI takes a step further and has further exclusions, just by applying a more stringent criteria on not just excluding the CCC, but maybe a single B or double B ESG ratings within that. And then you have sustainability, which, as I mentioned, takes a step further of having the exclusions, but then going a step further and just having an inclusion, a positive screen, to only include the best in class. But as you can see, that they're all very one-dimensional approaches to the ESG space. What I want to talk about is now the way ESG is developing into the sort of the second phase, ESG 2.0. And within that, you can see that ESG-weighted indices are being developed now, which apply the same kind of exclusions as you see in the ESG screened index, but are now applying a tilt towards the leaders within the MSCI ESG ratings and underweighting those that are the laggards. And what that does is more fully integrates the ESG criteria into the fund. You're getting a broad asset class exposure without having to restrict that universe, but you're getting a material increase in ESG score. And just to finish up, I want to sort of go through an actual example of this on an index that we have designed for our MSCI Sterling Liquid Corporate Bond ESG Weighted Bond Index. The starting point for this is a broad sterling investment grade index. To that, we have applied a liquidity filter. I mentioned at the start about the liquidity requirements for ETFs and the tradability. So we apply a liquidity filter of 350 million minimum issue size. We've also put a developed market only country of risk within this index. To that, we've then applied exclusions, the ESG exclusions. We're excluding any companies that get the MSCI controversy score of 0, those that don't adhere to the UN Global Compact and the like. And then to that, we've also added some business exclusions. So we think there are certain industries that shouldn't be included in an ESG index, such as tobacco, civilian firearms, military weapons, thermal coal, and oil sands. That's the exclusions. We then move on to the weighting methodology. And as I mentioned, MSCI have this 7-tier system. So the leaders, the AAA and AA rated, MSCI rated constituents will get a tilt of a factor of 2. Those are the laggards, the single B and triple C, will get a factor tilt of a half. And basically this is used to then reweight all those components, all those constituents, and come up with the overall index. And what we get is shown in the table on the right. So the idea is, as I mentioned, is to come up with an index that gives you very similar characteristics to an overall broad sterling corporate bond index, but with a material increase in score. Now the top half of this table shows you the normal fixed income characteristics. So the likes of yield, duration, credit rating, you can see are very much in line with one another. From the number of constituents and number of issues, you can see that the exclusions exclude around 10% of the universe from the standard index on the right to the ESG index on the left. But then it's looking at the bottom half of the table and seeing how those ESG criteria actually increase the ESG score. So if you look at the overall MSCI ESG rating, you get an increase from single A rating to AA. All the environmental, social and governance pillars also have a reasonable increase in ESG score, and you also get a much lower carbon footprint from this. So from that, as you can see, what you're doing is you're getting something that looks and feels very much like a sterling corporate bond index, but with that material increase in ESG score. And we think that just that second generation of ESG that doesn't just go down the pure exclusions route is now a very favourable way of looking at ESG investing for fixed income.
Thanks, Paul. A few questions to follow up now. In the presentation, you mentioned the strong growth that's been seen in fixed income ETFs over the last few years, which are primarily passively managed. Why would investors choose a passive management for their fixed income exposure?
Well, this has kind of been an ongoing theme. What we've seen over the last couple of decades is that the global economy has become more synchronized, central bank policy has become more synchronized. We've seen this with base rates going to 0 or even lower in some regions. And this overall increase in synchronicity between global economies and central bank policy, plus the addition of extreme amounts of QE, is causing bond markets to become more highly correlated with each other. If we look at the correlations between European and US government bonds, the correlation has been increasing over the last 3 decades. We can look at the same within asset classes such as investment grade and high yield bonds. And with that increased correlation is giving a bit of a headache to active managers. But what it's doing is it's meaning that for certain products, investors are now choosing in this low yield environment to go down the passive route. As I mentioned in the presentation, ETFs were adopted early by equity investors, largely because the passive argument had already been won. That argument is now coming into play with fixed income, not for all asset classes, but certainly for some, and ETFs are a great way to play that.
Can you comment on the demand you've seen for fixed income ETFs from financial advisors and how they're using them?
Yes, so we've seen strong demand from financial advisors. They're using them both as standalone products within their range and also within their model portfolios. I should mention that we launched our sterling corporate bond UCITS ETF in collaboration with AJ Bell in that process to use within a model portfolio. So we're seeing an ongoing demand as our range increases and as we diversify that range. We're seeing just increased investor choice, investor demand for the ETF vehicle within fixed income.
How does Invesco select or design fixed income ETF indices for both ESG and non-ESG products?
So I mentioned a little bit about the ESG process, index process within the presentation. But our normal starting point is to take a broad index, a broad asset class index, whether that's a government bond or a corporate index. And then we'll apply certain screens to that we think will make it more suitable for the ETF vehicle. So basically, as I mentioned, liquidity is a very important point within ETFs. We've needed to have the ability to trade intraday, and also to make sure that we're tracking very closely to that benchmark. So we'll normally overlay a liquidity screen such as the 350 million minimum issue size that we've had within the ESG and also the broad non-ESG sterling corporate bond UCITS ETFs. We may also look at other kinds of screens. So within certain universes, we'll look at where the most liquid or the best place to invest is. So for something like a global 81 index, we looked at that and we actually favoured the US dollar denominated because it was the largest and most liquid part of the market, which became the most suitable vehicle for the ETF. So we're always looking at the way we can adapt a broad index and make it better for an ETF and make it right for the investors.
You mentioned that there are several different styles of ESG within fixed income. Do investors sacrifice performance with ESG-focused products?
The simple answer to that is no. However, as I showed, there's a number of different styles of ESG. ESG isn't just one style of investing. So investors really, the ETF vehicle is really about giving investors the choice, that granularity of offering out there. So for investors that want to have something that looks very much like a broad index, just marginally improving their score, an ESG screened index might be the right thing for them to choose. For investors that are really looking to go to a much darker shade of green, then maybe that sustainable index might be right for them, but they'll have to accept a much higher tracking error versus a base index. As I mentioned, when we came up with our ESG weighted methodology, what we were trying to do is get somewhere between the two, something that tracked the broad asset class, but gave you a significant increase in that ESG score. So within that, the performance over the last 5 years when we've backtested the indices is very much in line with a broad index, so investors don't need to sacrifice performance.
How have fixed income ESG products performed during the COVID-19 pandemic?
They've actually performed pretty well. There's a number of different ways of looking at this. Again, looking at the different styles of ESG makes it slightly difficult to compare like for like. However, Bloomberg did a study of US corporate bonds just after the crisis, just after all the volatility in March. And what they discovered is that the higher rated, bonds with higher rated ESG criteria actually had lower drawdowns than those that had lower ESG scores. So one part of it is that they had a lower drawdown. Another study from S&P a couple of years ago showed that actually they're bringing in ESG criteria more and more into their broad credit ratings because it's all about sustainability in the future. So if you think your company's in an area that isn't going to last for very long, that's not going to be very healthy. So that ongoing sustainability. So broadly, we've seen that ESG is improving that performance. As I say, there are many different styles. And the other thing that we've really seen during this crisis is effectively a sector rotation. So when we've seen investors selling products, they sell the non-ESG version, the original version effectively, but as they buy an ESG labelled version of that product. So what we're seeing is that gradual rotation from non-ESG to ESG, which I think, overall is just going to be make ESG products a little bit more resilient to any further downturns.
And lastly, what do you think investors are looking for in ESG fixed income ETFs?
Again, that's a tricky question to answer. As I mentioned, there are many different styles of ESG. It isn't just one individual style. I think the whole industry is moving more towards an ESG based idea, and basically within that, you take your choices. And as I say, that rather than ESG being sort of the original style of ESG, which was just to apply an active fund management overlay to a broad asset class, you can now choose your style and how much tracking error you might want versus a base index, and how far you want to go down that ESG route. So I think really, and that's I think the message I would get across to investors is that fixed income ETFs offer the choice, and really that's the key. You can have a small pickup in ESG score and have close tracking to a base index. You can go through to a sustainable index and have much higher tracking error, but you're going to get a much darker shade of green. Or you can go somewhere in between, which will give you that, as I say, with our ESG weighted indices, where you're getting a material pickup in that ESG score, but something that looks and feels like a broad corporate bond index.